Hey, good morning, everyone, and welcome to this morning's Coffee Microcaps Morning Meeting, our third event of this week. My name is Mark Tobin. I'm the founder of Coffee Microcaps. For anybody who's joining us for the first time this morning, and for all our regulars, welcome back to this morning's event. I'm going to quickly run through these slides, and then we're going to get straight into it with our first presenter. Quick shout out to DMX Asset Management, our sponsor for all our virtual events here, Coffee Microcaps. We are looking for an active manager in the small and microcap ASX space. Please give Stephen or Michael an email or a call, or indeed check out the DMX Asset Management website. Just an FYI, we are getting back to live events in 2023. We've got an event happening in Sydney and Melbourne. Tickets on sale currently via the Humanitix ticketing platform, and the cost is there $40. Quick compliance and disclaimer slide. For anybody joining us for the first time, the companies we normally have presenting on here capped under 300 million in revenue and approaching cash flow break even, or indeed are already profitable, as are some of our presenters this morning. Generally from outside the resources and biotech sectors, what I like to call industrial microcaps, which encompasses microcap technology, financial services, healthcare, retail, and basically kind of all the other sectors you'll be familiar with. Structured this morning's webinar, we've got 4 companies presenting, each with a 30-minute slot, which we kind of going to break down to 20-minute preso and 10 minutes of Q&A. If you do have any questions for our presenters, please type them in the Q&A box rather than the chat function. Just makes it easier for me to moderate the questions when we get to Q&A. Please note the webinar is being recorded and will be posted on the Coffee Microcaps YouTube channel on Monday. You can follow us pretty much on all of the socials. Twitter is probably the best one. And I do write a monthly newsletter, which you can get on the Substack newsletter platform. First up, we're going to have Shaun Anker from Energy One, who's returning to give us an update on everything EOL. Then we've got another returning presenter, Tony Abrahams from AI Media, will be joining us after that. And our third returning presenter, we have Brett Kelly, Executive Chairman from Kelly Partners Group, coming on. And finally, we're going to cross over to WA, and Jay Albany from Wide Open Agriculture is going to give us an update there. That's enough from me. I'm going to stop sharing my screen. And Shaun, if you want to start sharing your screen, I'll let you know when I can see it coming up. It's just loading now. Yeah, I can see the cover slide of your presentation now, Shaun, so feel free to take it away.
Thank you, Mark. Good morning, everybody. Can you hear me okay?
Yeah, audio sounds perfect, Shaun.
All right, thank you. So thanks very much for your time this morning. I'm basically going to go through the slides that were in our half-year presentation, so there's nothing new here. We just rearranged them slightly for narrative purposes. Just obviously by a quick introduction for the company, those not familiar with the company, I'm sure most of you are now. We're in the wholesale energy software and services space for energy trading and risk management systems. We're offices in Australia, UK, France, and Belgium. We've got a hybrid business model of recurring revenues, about 85% typically, and one-off projects and T&M, which is usually about 15%. We offer solutions for trading of derivatives and also the physical commodity itself, which includes bulk electricity and gas usually. But about 50% of the energy in this country goes through our software on its way to the market. In Europe, that's a much smaller percentage, sort of 15% in the UK and 5% in Europe. So that gives us a bigger runway. We also, as I say, supply services for both for the physical market as well. A wide variety of customers, a lot of blue chips, financial traders, generators, retailers, and large customers. And this slide, it's in the deck if you want to have a look, but essentially just discusses the areas in which we get involved, which is, as mentioned, the wholesale part of the market, so the bulk supply management and risk management related to energy positions. Well, I happily come back to that, but obviously just that's just a bit of a background for those not aware. So about the company in the last half or so, recurring revenues up 42%, total revenues up 41%, EBITDA was up as well. Our CQ, which is Adelaide, and Exis integration projects are going very well, and I can talk about that. I'm pleased to announce that our CQ team in Adelaide won 2022 Broker of the Year for weather risks, because one of the other aspects we supply via CQ is weather derivatives and outage management products. We're about to go live with a battery auto bidding solution for a multinational customer. Obviously, batteries are very topical at the moment, and I'll happily talk about that. We've got some great technology, and we've got, certainly in this example, a multinational customer who is about to go live. We recently did a go live for a fully automated dispatch and control system. So we're talking there about an asset in which we both do the commercial trading in the wholesale market, and we also control the asset in an on-off sense. A good pipeline of projects and customers. We've got a proof of concept for a major utility in Europe, which is encouraging, and good market feedback and progress on our globalization program. For those who are familiar with the company, we are investing in globalization, and we can talk about that. So to the financial results, obviously I talked about both revenue and EBITDA being up. Net profit before tax was down. The main reason for that is that we are obviously investing in global operations. We invested nearly $500,000 in the half on making the company sort of operate 24/7 around the globe. And if we took into account the amortization of the intangibles which we acquired with our CQ business, the statutory net profit before tax would also have been up 26%. We were affected, and we still affected as a feature of the business, by project revenue. So that was again down 19% on the prior corresponding period. That's the one-offs I talked about. We have, whereas 85% odd of the revenue is recurring, we're still affected by projects. In Europe in particular, a general statement that obviously the energy crisis going on at the moment or recently meant that people were focused on their day-to-days and not necessarily interested in sort of procuring software projects. But we do have a project in hand. We're just waiting for that to start, getting to sign off and get going on that, and that sort of affected the result in the half. A quick look at the revenue. This is on the same period last year. That light blue band there, that's the projects. That's sort of waxes and wanes depending on how we're going with the large projects. But we do focus on recurring revenues and have done for a number of years. And I can report that in this time last year that it was up. So we have invested in people as well. As I talked about that project, we put 2 or 3 people on there. But there's a strong pipeline of projects going forward, including, as I said, the proof of concept. And we can dig into those numbers if anyone's interested. Again, just looking at the SaaS metrics, it's a feature of the business also is that we have a sticky customer base. Annual recurring revenue, 37.7 million at this point in time in the half. 350 odd customer installs. Churn was up a little bit, partly because, or sort of mainly because of some exits in Europe related to the high energy prices, particularly in the gas sector, but retailers, smaller retailers and so on. And so we see exits and mergers being a feature of the churn. We don't really lose customers to people just switching. It's more to do with exits or mergers. A bit more information on gross margins this time. I've been asked about this frequently. Our SaaS gross margins, excluding amortization, are about 80%. Then the software services and software margins that's our newer business line, 65%, and of course the implementation, which is the one-off, that's more like 40%. Automation is the key to growing margin on services, and happily talk about that. But this sort of business lends itself to automation. the trading in the spot market does, and that's what we're working on as well, investing in. And net revenue retention, a new stat this time for those who've been following us, net revenue retention 105%. So let's dig into that. We are well aware that the projects they wax and wane, and that obviously affects the result from half to half. Sometimes we get, I always say the projects are a bit like buses, nothing for a while and then get 3 come at once. That's the way it is. The big customers, they do their own thing. But we have focused for a long time on recurring revenues, and this is an attempt to sort of elaborate a little bit more on what we are working on, sort of get slowly away from the effects of projects. So this chart here discusses the organic recurring revenue growth. This is not inorganic, it's not acquired. The blue chart at the top, that discusses our most recent business line, which is not just the software, but also the services to help people operate the software. And when I say operate, we're not really trading, we're operating on behalf of the customer, putting nominations, bids, trades into the market under the rules that they give us. We don't make trading decisions. So that aspect of the business means that whereas someone may be normally a software customer for the trading platform, with services we're able to do it for them if they may be not able to because they don't have a 24/7 shift in their own business, or maybe they just want to outsource that work. And it's an important element for us because the software supports the services and the services support the software. We're seeing a lot of growth and interest in renewables. I mean, obviously, it's a very topical item. And of course, that's where the growth is coming from going forward. We're not always building any large baseload coal anymore. It's more about lots and lots of renewables and what they call firming generation, which is storage, either batteries or pumped hydro. So just quickly on that a little bit more, the 24/7 that we've been investing in, software and services added and developed, as I said, to complement our core SaaS business that we've been working on for a while. I follow the sun model, so we've got control rooms in Europe and in Australia, and we were able to often follow the sun. Our European 24/7 customers are now, the night shift is now being served from Adelaide, which is great. And we're going to roll that out, and do the same thing in reverse. As I said, a proof of concept. We're a very large European customer working on that now. We're aspirational about getting that signed sometime towards the middle of the year. Battery bidding, as I mentioned, pipeline of interest around the software, but also out of hours services and outsourced models, all part of our new business line. And global outreach, one of the things we're investing in is increased marketing going forward. And this slide just illustrates some of the things that you can find on our socials and on a new website that sort of collapses all of the product brands, and it just unifies the message. And we're very excited about that. And that website's now live, and we're already receiving feedback on that. So just on what this subject line we're investing in, software and services in the renewable space, we estimate that to be worth at least $2 billion per year by 2032. That's the spend. It's largely driven by renewables. We need renewables for electrification of the economy. By most estimates, the generation fleet in various markets needs to grow by between 1 and 3 times. A lot of this is it's a fragmentation story as well. A lot of the new entrants are smaller. Not all these assets are being built by the big guys. There's a lot of new entrants, a lot of funds, green funds, professional renewables. People who that's what they do, renewables development. And there's obviously a transition occurring as well amongst our traditional customer base. They're obviously building these renewables as well and shifting away from fossil fuels over the medium to long term. And so a lot of these things are called distributed energy resources, but that's not the only use of it. It talks about things that on the customer side as well, like either embedded generation that we're all familiar with, solar PV, or curtailable loads and the like. So the market is changing from a one-way traffic to two-way traffic over the term. But of course, gas is still vital and will be for a while yet while we make the transition. So putting us software and services together is an enviable position. A lot of our existing competitors are more software related. We definitely think we're onto something with adding the services into the future to help customers who are maybe either, as I said, not large enough to operate themselves on a 24/7 market, or even large customers who don't want to do the night shift and are happy to outsource that. So that's the service we provide. It's a combination of these things bundled together to provide a solution. Quick summary here. As I mentioned, project revenues affected by the timing of large projects. Pipeline is good. We'll talk about that. We're focusing on the new business lines with organic recurring revenue, which has been a feature for many years, but investing more and more into the ones that are strongly growing. Margins are good and remain strong, and there's an opportunity to grow margins as well. We have an exciting global opportunity, a massive global opportunity, and Energy One is well placed to service that new market as and when it comes online. And lastly, the board maintains guidance for 23, which we put out earlier. And so we just need to crack on with our projects and our strategic objectives, and go forward and help the community to overcome, go towards the goals of net zero by 2050. So thank you very much. 17 out of 20 minutes. Hopefully, Mark, I've kept to the time. So ready for any questions.
Yeah, thanks, Shaun. We've got one here from the audience already. Can you talk about your software pricing versus peers and any price rises? I think inflation is top of mind for a lot of businesses, and for yours is no different.
Thank you. Good question. So slide. Typical contract length is 1 to 5 years initial term, and then they're what we call evergreen contracts. They roll over. We would typically have a CPI style clause in there. So yeah, whatever the CPI is what goes through. That's a feature of nearly all I'd say all the contracts have got such a clause in them. So we're able to push that through. Now, of course, obviously mindful of customers, and and inflation being what it is, there may be an example where it continues along this line. We're not able to sort of ask customers to do all of that, but for the most part, and certainly the answer to the question is that we do raise our prices by CPI. As for pricing pressures in the software market, more competitive more competitors in Europe, and so there's competition will be quite fierce in dealing in the software market. So yes, like every other business, we have to be mindful of being cost effective for the customers and value for money, as well as also trying to sort of beat out the competition.
Next one, Shaun, maybe slightly technical, but I think it's worth looking at. Is there an opportunity to develop software for demand response, such as load curtailment in response to wholesale prices? Thinking large industrials and hydrogen electrolytes here. So I don't know if that's part of your niche software suite or something that's an opportunity down the line.
That's an excellent question. So yes, it's the short answer to that. We have our automation suite that I talked about. We are now, in fact, controlling assets on the generation side, literally turning them on and off. We're doing that already. On the other side, the embedded side, Traditionally, we've dealt with larger players. So if it's grid scale, then typically we can, that's more of our sweet spot. In time, it will obviously, as the market changes, smaller and smaller players will be able to trade, in and out of the market. It's what they call a two-sided market. So that's something we've got in mind to develop into. To that exact point, that exact question. It's not so much now, but it's definitely something that's coming down the wires, if I may use that metaphor, and we're aware of it, and we have the technology to do it. It's not so much the technology in this case, it's the fact that in the current market setups, to be able to trade, you have to be a financial participant. So it's rare to find companies or customers who are big enough to actually be able to trade in a wholesale market, as opposed to an engineering solution which is switching things on and off. Hopefully that answers it.
Thanks, Shaun. And then the next one, capacity within your headcount to take on, a large project of work, is, hiring in this industry an issue. So, yeah, how you're finding the labor market for talent, be that, the UK business, the French, Belgian business, or the Australian business?
Yes, well, there's a couple of questions there. So first of all, we're pretty good at this. We're pretty good at projects, and we've got a good base. We might flex a little bit if 2 projects came on, but we're perfectly capable and have done for many years, have demonstrated that we can do 2 or 3 large projects at once. But the good thing about the industry is, of course, it is highly specialized, and if you've got good people, and we do, then you have a really good talent base that you can deal with. They are specialized people. Obviously, wholesale energy trading is quite a sort of technical and interesting industry. So we've got a good pool of people, and so that's part of the strength of the company when we're marketing as well, as we're able to point to our talent base. So I think it's a moat, it's a barriers to entry for other people as well, and it's something we do focus on, making sure we retain good talent. We have very low turnover, and we're very proud of the good people that we've got working for us.
And then another one, Shaun, I think somebody might have just missed this slide. Your estimate market share in core software in each geographies. I think that was on the slide you mentioned somewhere. Maybe if you can just quickly go back to it, just for the sake of
that one
clarity for the person asking this question. Oh yeah, there it is there. So I mean, it's basically dominating the Australian market.
Yeah, so we measure it by, if you like, megawatts under management rather than spend. So this slide is referring to that.
Okay, great. And then another one, regulatory changes, positive or negative in any of the geographies you work in. Obviously, it's been, the energy market in Europe's been turned upside down over the last 12 months. What is flowing out of that? That's, it's either more of a positive or more of a negative. If you look out another 12, 24 months, and now that, I guess the new environment has established itself.
Well, it's a truism, Mark, that the regulatory change is helpful for our business. Whenever politicians get involved and tinker with the system, that's good, because all the participants then have to do something, and of course then we can get involved. So generally speaking, it's good for us. In a regulatory sense, the disruption that people have experienced in the market, and has been certainly in Europe the largest crisis in energy since the 70s. I don't think anyone's dispute that. Gas prices went up 10 times what they were the year before. It's settled down a bit now, but obviously that focuses the mind of our customers on what are they doing about managing risk and managing their exposures. So we help them with that. We help them manage it. We help them manage price risk. We help them manage basis risk, counterparty risk, those kinds of things. So whereas a crisis is not enjoyable for anybody, and no one will pretend they do, when that settles down, it indicates a tailwind for us, where people perhaps have maybe put off putting a new system in or getting some services done. They think, well, we need to get back to this. We need to do that project that we put off for a while. So in the fullness of time, we expect that these kinds of trends are really good, not to mention the macro trend, which is electrification of the economy in the next X years, because that's something we all need to do to get even close to our aspirations for net zero.
And then another one, Shaun, on acquisitions. I mean, EOL has done more than its fair share of acquisitions over the last, let's call it 4 or 5 years. Is that still part of the core strategy, or is it more, given the numbers on this slide for the UK and Europe, it's like building on the beachheads that have been established now, and just growing organically in those markets, given the amount of headroom that's available there versus a more mature market like Australia?
Yeah, absolutely. We feel we've positioned ourselves now with our ability to provide a suite of solutions to customers, software and services. Sort of indicated that for the next wee while, we'll just focus on what we're doing, building out our current trajectory. If obviously acquisitions are available and they make a lot of sense, that's something we would look at. But really, goal for the next X months is to focus on what we're doing and build out our capabilities and build out our, make the most of our platform.
And then maybe a final question was on the battery project for the multinational. Is that just for their Australian operations? I'm not sure if you mentioned which geography, and if that goes well within, let's say, the Australia geography, have they indicated we can roll this out to where they're operating outside of Australia?
That's certainly an aspiration. Yes, our focus is on trying to get into a partnership arrangement with large customers where we can service them globally. One of the main reasons for the globalization program. So it's the idea is that we can service customers who may have a global portfolio, and that's what we're gearing up for. That's what they're interested in. People might have assets all over the planet, and they're the people we're aiming for. So absolutely, we want to roll these out, and they're not point solutions. It might initially be that, but definitely the aspiration and the aim is to do a rollout story. And
do you think there'll be further updates on that, or a bit more detail on that when we get to the full year results?
Yeah, 100%. That's the plan. This is we've investing in globalization, and appreciate that. Obviously, that comes at a cost, but we're fully invested in providing feedback on how that's going, so that everyone understands that the progress of that program and the benefits of it, and we will keep everyone informed.
Okay, great. Shaun, let me just double check I know we're pushing up on time. I just want to make sure we've tackled all the questions here. I think we have. So Shaun, we might leave it there. We've only got less than a minute, so let's not squeeze in another question here. But thanks very much for coming back in and giving us an update on all things EOL. And hopefully we can see you at some stage later in 2023.
Wonderful. Thank you, everyone. Thanks, Mark.
And I do know we have Tony Abrahams from AI Media standing by. Tony, if you want to start sharing your screen, I'll let you know when I can see it. Yeah, I can see the cover slide of your presentation now, Tony.
Yeah, great. Thanks very much, Mark.
Okay, you can take it away.
Thank you very much. And thanks everyone for being here, especially during this busy reporting season. So AI Media is very well positioned to take advantage of the benefit from fast emerging improvements in AI. We are deploying the latest AI specifically to make quality automatic live captioning and translation a reality with our global, scalable and secure ICAP platform. Essentially, the turnkey solutions that we offer are a result of a very significant acquisition that we made in 2021 of a company called EEG Enterprises in the United States that had a 40-year history of providing physical and virtual encoders. This is fundamentally the strategic competitive moat that we have. When people think about the explosion in artificial intelligence and automatic captioning, people often wonder why AI Media has any competitive advantage in this space, given the amount of tens of billions of dollars that are being put into this industry. And the short answer is on this slide here. It's about how do you actually get the audio into the speech recognition engine, and that's the encoding technology. How do you then connect the latest artificial intelligence algorithms with that content? And that's delivered through the ICAP cloud platform, which connects each of those encoders to that cloud platform. And then a further layer of artificial intelligence is added with our own proprietary IP through the Smart Lexi process. Unpacking that a little bit, and effectively the solution for our customer set, which is large broadcasters and what we're calling broadcast adjacent spaces. So this is where you've got enterprises that are beginning to look more and more like broadcasters. These include parliaments, municipalities, cities of courtrooms, things like that, where the recording solution needs to be professional. The recording solution is not contained within another walled garden like Zoom or Teams, and where the tight integration between the captioning, which must remain secure and private, that is tightly stitched back into our customers' media asset management systems or libraries effectively. And so that encoding technology is both physical in terms of the ICAP encode series, virtual for the Alta series, and cloud-based for Falcon. The entire ICAP platform supports this with 99.9 uptime and state-of-the-art encryption, ensuring that our customers' content is always protected. In terms of the highlights for the year, total revenue, as in the last several halves, has been flat. And this is a result of an active transformation of the business away from higher cost but lower margin services business to a lower cost but higher margin technology sales. And so while total revenue was flat for the half, gross profit was up 13%. Our technology sales have increased to 38% of our total revenue, up from 28% on the PCP. And this is shown through very strongly in the margin uplift, which is up significantly from 53% to 60%. A healthy cash balance, positive operating cash flow, and a $1.4 million improvement in the EBITDA performance. Driving all of this has been this increase in the automated transcription product known as Lexi. And excitingly, we're able to disclose for the first time also what that Lexi revenue is. We needed a couple of years with that revenue under our belt from the acquisition to provide the comparatives. But what it shows is that not only is Lexi growing at 105% in terms of volume, but the total revenue is growing at 15% greater than that, suggesting that for this breakout product, we do actually have significant pricing power, I should say, and that we're certainly not seeing these prices go anywhere close to zero. And the reason behind that is because of the requirement to get that high quality audio into the system, to be able to get those captions back into the system, and then to make sure that those captions are available for our customers after the fact. So some really good logos that we added in the last 6 months. A really important one is on the left there, existing ICAP customers. So these are often customers who've been using our competitors, who are now switching across to using the Lexi service. It really significantly is BN Sports and CBS Sports. This follows the breakout improvements in artificial intelligence that have rendered sport capable of being delivered with automatic speech recognition. This was not the case 18 months ago, and the improvements that we're seeing are continuing to build on each other. We are seeing step change improvements in AI, which I think a lot of people on the call have experienced themselves through the breakout success of ChatGPT, and how you'd compare that to, you know, one of the very inferior bots that you might have experienced when you were renewing your insurance premiums on a site. It really is chalk and cheese. We've known that this technology has this capability for several years. We started investing in it in 2017, just after we launched live captions on the global Facebook platform. And what we're starting to see now is improved customer awareness of the capabilities of artificial intelligence to really transform the way that they deliver captioning, transcription, and then archive that content. So it's a very exciting time for us. We renewed very key contracts with Foxtel, Al Jazeera, and Channel 7. We signed new agreements with SBS and Google. We've also signed with Major League Soccer. And then the three logos on the third column are really exciting as well. That's the city of San Francisco, the city of Austin, and the city of Baltimore. So our first opportunity is to really take the captioning into those broadcast adjacent spaces. And then, of course, partnerships across the field with technology partners, third-party captioning providers, and event streaming companies. The strategy that we've had over the last 2 years is to continue to grow the ICAP platform minutes, but also to grow our automated Lexi service much faster. And this graph really shows the success of that. When we acquired EEG 18 months ago, 16% of total traffic was delivered with the automated service. At the end of December, it was 35%. At the end of January, it was 37%. So we are seeing an acceleration in the capabilities of AI to deliver accurate captioning at a much better price point for our customers and at a much better margin for us. That SaaS growth in some bar charts. So we've moved from 100% services revenue, which has a margin of around 40%, to 38% of the total now being with technology sales at a margin greater than 80%, which has led to the improvement in our operating cash and EBITDA performance. We won a couple of awards, which was great. One at the Innovation Oz Awards last November, and one just a couple of weeks ago from APAC Insider on the best captioning and translation provider for 2023. In terms of a bit of a deeper dive on the financial performance, the macroeconomic conditions at the moment, with customers obviously being very focused on spend, we actually have some fantastic products to ease that transition, using AI and Lexi to massively lower costs, enabling customers to get the most out of that live data by delivering it really quickly. And UK Parliament's a great example of that. They've managed to lower their transcription costs by improving the inputs that they give to their outsourced transcription company. And then migrating existing full service customers across to a more technology solution. And that's something that we're well underway with with Channel 7. In terms of how that looks over time, so with that improvement in the operating model, those margins have increased from 38% at the IPO through to 60% today, and that's seen a turnaround in EBITDA from a loss of -7 million to a profit of 1.4 this year. And excitingly, we're kind of just getting started on this sales journey. I won't spend too long on the P&L, balance sheet, and cash flow statement, but suffice to say that it's in that cost of sales line that we've managed to keep very contained, and in the OPEX line that we've also managed to keep contained, that we're starting to see some real operating leverage come into the business. In terms of the balance sheet, the one thing I did want to call out is we are going to continue to be operating cash flow positive, EBITDA positive as well. We do have a loan that's repayable to the vendor of EEG at the end of just after the full year results. We do have enough cash to pay that out, but one option may well be if we are seeing other opportunities in an M&A sense to keep some of that for a bit longer. In terms of that cash flow from operating activities offset by final payments to an ACS vendor in terms of investment activity, but a very comfortable cash balance. In terms of the strategic outlook, just a quote here from Satya Nadella, the Microsoft CEO. The age of AI is upon us, and this is obviously with reference to the breakout success of ChatGPT, which got to 100 million monthly active users 4 times faster than TikTok did. So we are seeing almost magical improvements, I guess, in what AI can do, and the implication of this for automatic speech recognition and for Lexi is as profound as it is for ChatGPT. I do get a lot of questions from people as to whether ChatGPT is a threat to AI media, and what really the impact of ChatGPT is on our business. The first thing to say is that ChatGPT is not a transcription tool. Chat itself is a consumer function to engage with the artificial intelligence database of GPT. So by itself, chat is not a threat in any way to Lexi. But in fact, the core GPT underlying technology that interfaces with chat is actually something that has been significantly invested in by many companies in this space over recent years, and has seen equivalent breakthrough improvements in the accuracy of automatic captioning, as we've seen in its ability to handle chat requests. And now, alongside those improvements in GPT, we've had analogous improvements in BERT, natural language processing, and acoustic and pronunciation modeling. I have included in the slide deck as an appendix some further detail as to why improvements in all of those disciplines have led to the breakthrough improvements in the out-of-the-box automatic speech recognition. And the really important thing to recall here as well is that that is just one indicator of success of the overall solution. Again, the out-of-the-box ASR, as good as it is going to be useless if you can't get the audio into the system. And that is fundamentally what our agnostic AI compatible encoding technology does. It gets the audio into the system in the best and smartest possible way. It can have multiple isolated audio inputs, for example, from different commentators in a commentary booth. It can denoise a lot of the background noise, and all of these things massively improve the performance of the ASR. And then, of course, we have our own AI layer on top of that through our smarts. I'll wrap shortly and then Mark take some questions. But effectively, our AI moat has sort of 5 different elements to it. One is those ICAP encoders, and that's really where it starts. It's the best of breed AI algorithms that feed into Lexi. It's our own AI enhancements that improve the contextual accuracy of that live captioning. That can be human, but it can also be technology-based, so a much tighter integration with our customers' metadata. It ensures that we are able to deliver a better quality automated service without any additional human intervention. The ICAP cloud is critical because it obviously connects all of those devices, but it also connects to the ICAP cloud, which means that any improvements in ASR technology can be passed on immediately to all AI media customers. And then, of course, really critically, we still offer those premium quality services powered themselves by AI to ensure that we are able to deliver those marquee moments of content at a quality level that our customers expect. So if you think of the halftime show at the Grammys, for example, Lexi is not going to perform well on that, where you have important lyrics, background noise, music, and even speaking in Spanish. So AI media as being that full service partner for customers is something that we're not seeing competitive threats from on the technology only side of things. In terms of those improvements in AI, first, we are very well positioned to take advantage of that, and we've been preparing ourselves for this moment for some years. But importantly, this AI inflection point that people are experiencing now with ChatGPT is basically the best advertising campaign we never paid for. People are now starting to open their minds as to what we know is possible with this automatic technology. So key takeaways, the SaaS transformation is continuing. We are in the midst of a multi-year growth strategy that is accelerating. Near term, we are continuing to build momentum in live sports, as this is really at the cutting edge of where the technology is now capable of delivering where it wasn't a year or 2 ago. A strong cash position to execute on our growth strategy, continuing to grow that ICAP platform growth, which is in turn fueling the increase in Lexi minutes and Lexi revenue. And then that business model, which continues to be powered by a competitive advantage, which is anchored in the encoding of the audio in a way that ensures that the speech recognition engines get the best possible outcome. And I will leave it there and Mark, hand over for some questions.
Thanks, Tony. We've got a few here. First one, Lexi's walled garden is built with physical encoders and Falcon and Alta. This half-year device sales were fairly flat. Is there still supply chain issues or customers pushing back on investments? How did Alta and Falcon sales do this period? The first one.
Great question, Stella. Thank you very, very much for that. So you're right in the sense that the Lexi walled garden does rely on encoding solutions. And you're right also that the device revenue was relatively flat this half on half. What's important to stress in that context, and I might actually just flick back to the slide that, that talks about that, is the hardware is only the ICAP encoder. So the devices just go into hardware, into the physical encoders. Alta and Falcon, in the sense that they are SaaS pricing products, are not included there. So as we are seeing more and more customers migrate from the physical encoders to Alta and to Falcon, then we would expect to see the growth rate being faster in SaaS than it is in devices, which is exactly what we are seeing. So we've had some strong early sales in Alta and Falcon. But the other thing to point out as well is that a physical encoder tends to last for 5 to 7 years. In the old days of EEG, that would be the extent of the revenue. What we're now seeing is that actually customers are pumping much more Lexi through those encoders year on year than even the cost of those encoders would be to refresh that year. So in effect, what we're doing is we're setting ourselves up as a bit of a land grab to then enable us to deliver more and more Lexi over those products. So we're very happy with the level of sales with the encoders, both the physical ones and the virtual and cloud-based, and we'll be looking to continue to grow those in the years ahead.
We'll take another one from Stella. FY22 suffered from education customers moving to free ASR products, native within Zoom here or Teams. Are the free or cheaper competitors still winning some volume from Lexi? And if so, in which segments? I presume she means industry verticals. And I do note, I got the email myself, there's some big upgrade of Teams coming some stage this month, so probably relevant.
Yeah, look, most of that, Stella's absolutely correct that most of that happened last year. And in fact, we pretty much saw that revenue kind of completely disappear effectively last year. So we're not seeing it continue to hemorrhage at all. But what we are focused on is those situations where you're not just entirely within a Microsoft Teams environment, or you're not just entirely within a Zoom environment. And they can be obviously broadcast instances, they can be baseball stadiums, they can be city halls, and they can be, live commissions of inquiry in courtrooms. None of those are going to be disintermediated, if you like, by a different walled garden, and that's certainly where the focus of the business is, and that's been part of the transition. Yes, that's certainly why revenue has been relatively flat, and we've seen a decline of 15% in our services revenue, but we've more than made up for that with an increase in our technology sales at much higher volumes and much better scale, and we want that to continue. So we're not focused on winning back individual students who might be on Zoom or Teams. What we're focused on instead is rewiring a lot of these enterprise accounts with our physical, virtual, and cloud encoders that then ensure that we are then, as part of that broadcast stream going forwards, and looking for a different type of customer to those that AI media traditionally supported in a one-on-one sense for a deaf or hard of hearing student in a classroom.
And I think you did talk about this, Tony, but maybe it might be just run over it again quickly on the slide. Can you talk the different gross margins between your products and services?
Yeah, sure. So basically the services business delivers a margin north of 40%. And our technology products, which include the devices, the hardware, as well as the virtualized encoders, Alta, Falcon, and Lexi, taken together, deliver margins greater than 80%. Mark, not sure if you're there.
Sorry, Tony, I flicked back onto mute there. Sorry. Just a question for me on you mentioned the Microsoft CEO who mentioned digital optimization spend, i.e. a drop in revenue from Microsoft. Are you seeing when you're talking to customers, whether they're renewing or it's signing up new ones, they're compared to 12 months ago, there's a kind of a heightened focus on cost and what we're getting and what we're not getting, and just really narrowing down to look at this is exactly what we need, and we don't need any of these bells and whistles? Or are they, you know, in the AI media space, it's okay, we understand the total value package and we're still happy to go with that?
Yeah, it's interesting. I probably would have expected more of the former, and what we're seeing is actually more of the latter. And the reason we're seeing more of the latter, which is people actually getting the transformative value of this in a way that they didn't before, is because of the nature of this technology solution. It's able to be always on. And there's an enormous additional benefit downstream of having a service that's always on. And I'll use an example that we have shared in the past in relation to Channel 7. So what we did with Channel 7 as part of the renewal was that we not only did we introduce Lexi and ICAP and all of the encoders, which, you know, improve the outcomes for Channel 7, but we also helped to solve a big problem for them downstream, which is how do they best index their video archives? And so what we built is a sub-silo implementation, and sub-silo is our product that ensures our customers get most out of the captions after the live event. It's named because it's a silo, which means it's protected and from the outside, and it's subtitles. So it's a silo of subtitles, basically. Now, when we add time code to those subtitles completely automatically, and we stitch automatically today's content with that digital archive, well, that is available for searching by keyword for anyone at Channel 7 at 8 minutes past midnight the following day. Now, this replaces a solution where people would have had to search on manually keyed in clappers that sit at the front of a long tape. They would have had to scroll through it, and in some cases is actually saving people over an hour a day in terms of putting this content together. So again, these are solutions that wouldn't have been possible unless you're delivering 100% captioning, unless you've got the capability for this service to be always on, and unless it's delivering a high enough accuracy level, which just like ChatGPT, this is its moment in the sun. And we are effectively saying, yes, it's not good enough yet for everything, but it's certainly good enough for more and more content. And we will be your co-pilot as you go through this AI journey, making sure that we choose the most cost-effective solution for each of your content. And effectively what we're seeing, Mark, is that many customers are coming to us and saying, oh, well, we had the same budget. Can we apply that same budget and do 4 times as much captioning and get tighter integration, et cetera, which is exactly what we saw with, say, Sky News. And so while there certainly is the case that some customers are trying to cut their spend, actually people are looking at things with much more of an open mind and going, well, actually, I could save more money downstream in other applications if I had better access to accurate transcript data very quickly. And that's part of the product proposition.
Okay, and then another question, what percentage of ICAP users move off premium service and then get, you know, captured by Lexi on the win over? So it's that kind of transition.
That's a very good question, Stella. Well over 80%. Well over 80%. We're very happy with that.
And then if I can just ask a follow on maybe to that one, in terms of the transition, you know, you're talking about there, and which is causing the margin uplift despite, you know, the revenue line not moving a lot. I mean, how far are you through that transition, and, you know, where do you think it can finish up in terms of, because I'm presuming there will always be some kind of services business for a certain cohort of customers, but where, if we look down the line 3 years from now, do you think the split will be, and what, you know, that kind of transition is going to look like over the next 18 months or 24 months?
Yeah, great question, Mark. Look, I think we've said publicly that we want to exit FY23, so like June of this year, at a 50-50 split. And we're on the way to that. Where do I think it will end up? I think over time it'll keep inching up. But I do think there's probably going to remain for the next 5 years at least, a core 40% of the business that is going to be delivered with premium services. And that'll increasingly be more and more kind of difficult, unpredictable, multi-speaker, background noise type of content. But that also tends to be the content that's most important and has the most viewers. So customers want to make sure that for the halftime at the Grammys, we've got it covered. And then for the other 90% of the content, that it's being delivered with that scalable solution.
And one more, Tony, if we can. Obviously, you know, called out renewals and a lot of customer wins, and you know the base of customers seems to be growing. But is there still any kind of, you know, key customers that are, you know, quite a large part of revenue that you like need to re-sign over the next kind of 12 months or so?
I know, Mark, I think I just lost you. Could you just repeat that?
Sorry, I was just talking about the, you know, the broadening of the customer base that has happened over the last 12 or 18 months. Is there any kind of major customers that need to renew in the next 12 months that, you know, we need to watch out for, that they're still, despite the bigger base, it's still a key customer for AI media?
Actually, no. We've got a pretty clean 18 months, 2 years coming up in terms of those big customer renewals. The last ones were Channel 7 and Foxtel, which were the big ones that were expiring. So yeah, actually, it's a bit more upside than downside for us in the contract space in the years ahead.
Okay, perfect. Tony, we'll leave it there. Thank you very much for coming back in and giving us an update on all things AI media. And I do know we have Brett Kelly standing by, along with Kenneko, the CFO of Kelly Partners Group. Brett, if you want to start sharing your presentation, or maybe, I don't know if Kenneth's driving the slides. Yeah, they're coming up now. If we can just go to full screen mode, please, or start slideshow.
Sorry, Mark. I think Brett prefers to do it this way. That way you can see the next slides.
Okay, perfect. Yeah, we can run with that.
That's okay.
So, Brett, take it away whenever you're ready.
G'day. Mark, do you want me to start video? I can't start my video. I'm not sure how you want to do that.
It's fine. We'll concentrate on
Perfect. Easy. Well, good afternoon to everybody. Thanks for joining us. I hope you find this interesting. We founded the firm in 2006 as a chartered accounting firm that we thought we could modernize the industry by doing better things for our people, clients, and communities, and that's proven to be true. We always share the second slide, KPG, in 10 seconds for anyone who's busy. Revenue growth continues to be a strong feature of what we are good at Kelly Partners. Our EBITDA margin has compressed as we've taken on the largest chunk of growth in the last 6 months that we've ever taken on. Parent NPATA is up. Return on equity, I think, is very strong. Gearing is very moderate. Cash flow is very strong, and our cash conversion, I think, is excellent. But they're quite good statistics that we've published every 6 months for some time now, and is helpful, I think, and useful to anyone interested in understanding our business from a financial perspective. On slide 3, capital allocation inspired by the book The Outsiders by William Thorndike, that we love a lot. These are what, from a capital allocation point of view, we strive to do: improve the earning power of our operating businesses, further increase the earnings through acquisitions, growing our existing accounting subsidiaries, organically growing our complementary businesses. And I'll just call out, we've got about 7.7% organic growth during the 6 months, with about 34% growth via acquisitions. Making programmatic acquisitions, so small but consistent groups choosing to join our group, and making occasional large acquisition greater than 5 million in revenue. We haven't done one for 4 or 5 years. Number 5, repurchasing our shares and certainly not increasing the number of shares on issues. So since IPO, we will have more than doubled our revenues while not raising any further external capital or issuing any shares. On page 5, our growth per share is strong, and I'll leave that for you to look at, but we're compounding strongly over time. We aim, like our friend Mr. Buffett, to be judged on 5-year periods, and the last 5 years has been, since IPO in June 17, excellent for the business. In terms of people, services and clients, we've got a very high net promoter score from our employees. So employee net promoter score, we've got strongly growing revenues that are focused on accounting and tax. Audit, I'd call out, is less than 5% of our revenue, and our larger competitors have typically 25 to 45% revenue in audit that we think is less profitable, more risky, and more likely to be affected by technology changes in the future. And then we now have 17,000 client groups, assuming that there's a couple of husband and wife involved in those groups, about 35,000 people, which is a great community of private business owners, predominantly Sydney, Melbourne, and increasingly growing into Queensland. That's grown by 26%, and we think has tremendous potential to be quite awesome over time. On page 7, office numbers have grown from 19 to 28. There's an outline of the geographical spread of the group. On slide 8, we're just sharing that the cadence of our acquisitions continues to grow over the 5-year periods. Looking back, 6 in the first 5 years, 8 in the next 5 years, 27 in the last 5 years. We're confident we can increase the cadence of acquisitions as more and more firms are aware of us and choose to join our group. On page 9, and I think very significantly, is the business is not a new business sort of popped together over 3 seconds pre-IPO. Business was founded in 2006. We've doubled the business 5 times in a row, on average every 3 and a bit years, and I expect that we'll have another double coming up imminently. And so we think that points to, this is not an accounting firm, but a group that has a business system for improving accounting firms and making them part of something that's better than they would be as individual standalone businesses. In terms of growth, revenue and EPS, it breaks down on page 10 as accounting grown by 5.6% organic, 2.1 complementary services, and acquisition 34.5, so for 42.2% growth. Annual compound growth rate since 2006 is 30.5%, and earnings continue to compound since IPO. On page 11, anyone that's interested in the business, we always publish a reading list. A book that we think is worth reading is The World is Flat, Brief History of 21st Century by Thomas Friedman. And I'm basically making the observation to our partner shareholders that we can't continue to invest and deliver world-class people, client, and community impact we're known for and justify that investment if we don't do that on a global basis. It takes the same amount of capital to act locally as globally. Our clients over the next 25 years, and we're about building an enduringly great organization, are all going to have to earn a return on a global basis. And they'll need their accountants to help them operate in that new global world, and importantly, to think that way. We've always been a business that would rather show people than tell people. And so we are aiming and have upgraded our strategic intent for the next 5 years to become, on page 12, Australia's global accounting firm for private business owners. We make the observation that we're the 13th largest economy in the world, and yet larger economies have global accounting firms, but we don't. We're like a tributary state that takes the sort of dregs of the global accounting world brands and slaps them on an organization down here. We don't think that's been good for Australian businesses, and we're not sure that we can be better, but we're confident that we probably can't be worse over the next 25 years. And so on page 13, we've opened a group office in Malibu in California, pursuing, when we say growth into the United States, we mean California and specifically Los Angeles, to duplicate our partner owner driver model in that market. With between 15 and 20 sites that we've identified in Los Angeles where we think we can add value. And in the United Kingdom, out of London, we'll have a group office by the end of 30th of June, maybe sooner, to pursue our partner owner driver model in that market. That will give us Hong Kong in Asia, United Kingdom and United States, and we may well do something in Dubai. 5 global regions where Australian businesses either exist today or want to grow into tomorrow. And they, in my view, should have an Australian accounting firm that shares their aspiration to earn a return on their invested capital on a global basis. So that's first mindset, and then systems and processes and amazing professionals to make that happen. On page 14, our 5-year plan that was first published in 19 will achieve that revenue by 30th of June. We will, which will be a year early, which is terrific, and our underlying profitability is certainly at those levels. On page 15, our next 5 years, we've basically scoped out, in terms of strategy, objective, scope, and advantage. So top 10 in Australia while we scale complementary services and go global. In terms of scope, you'll see there our services and where an advantage. We think that our business system is a huge advantage. On page 16, our business system really, as a minimum, consists of a group business model or a group structure, centralized services team with a business model, partner owner driver way of structuring firms that we have trademarked and that is unique and that we've rolled out since inception on now more than 70 transactions and partnerships and or partnerships, and this central progress team that does very cool things for our businesses. The impact on an underlying business is that we can generally at least grow the profits by more than 50% of an underlying business and return at least 25% of partners' time to them, while taking away the things that they didn't become accountants to do, and therefore make their work and values experience of being involved in a chartered accounting firm much better. That's emphasised by a higher ENPS for our team and a virtually non-existent turnover of partners in our more than 75 partner partnership as it stands. Well, that's a quick overview. I hope some people saw our results in more details, and they're on our website and on the ASX website. And I thought today, got a little bit of time, Mark, I'm happy to take any questions if people want to pop them in the chat or ask them out loud.
Thanks, Brett. I might just get the ball rolling. Just on acquisitions, you say in your slides there, you haven't done a larger one in the last couple of years. I'm just wondering why that is. Is it pricing from the principles of those larger ones, just are not realistic or not in line with what you wanted to pay, or specific opportunities just haven't come across your desk? Why have the larger ones kind of eluded you over this last kind of, let's say, year or 2 years?
So Mark, the largest acquisition we've made was between 8 and 10 million of revenue. We said 8, the vendor said 10. We have no aspiration to buy large firms for the sake of it. So typically our industry has celebrated size above all things. We're a business that is a for-profit business and believes that our partners who sign joint and several guarantees and put their capital and good name and reputation at risk should earn an appropriate return. Many of the large firms are focused on being large rather than great, and certainly financially, are average at best. So we're just not focused on that. In Australia, there's only 100 firms out of, say, 32,000 firms that are over 4.4 million in revenue. And so for us, with a programmatic acquisition mindset, we're really targeting firms that we think want to be part of what we're doing.
And then one from the audience
here. Certainly not pricing. Yeah, certainly not pricing. I can't say that we've really even engaged in a discussion with a large firm.
Okay. A couple from the audience. In the past, have you had any acquisitions that haven't gone to plan, and what was the kind of work then to kind of rectify the situation? I'm sure And despite the best due diligence, there's always one or two that go slightly awry. But yeah, maybe just comment on when that does happen, what's the kind of rectifying course of action that you would normally take?
Good question. So we've done more than 70 of them, so you can assume that to be able to keep doing them, but most of them have gone okay. For a deal to go to be more challenged, really, I saw a great book by a guy who's been writing a lot on the Stoics. The title of that book's "Ego is the Enemy." So if we get an egotistical vendor who doesn't believe that anything can be done better and that everything was always done perfectly in the past, then we will do everything we can to avoid bringing that type of person into the group. And in the past, where we've had some difficulties, and I'm just trying to think, there's been 2 out of 70 something that were just not as amazing as they could have been. And that was, where you had, in one case, a vendor that wanted to go up the road and try and start again, which they weren't able to do. And another case, 2 other cases, really just egotistical vendors who want to sell you the business, take a check, and then tell you how everything was better before they sold the business. So, we're pleased that we've been careful to not partner with people with those values. And of those 3, the third one being a person in a multi-partner firm that we partnered with, it didn't actually matter because they were one of a number of partners, and they were older and they wanted to retire. I think, I'm not sure whether they were just cranky in their old age or whether it was us. So yeah, look, people are important, and whether they really want to join our group or just want to check is kind of the first filter.
Okay, great.
To rectify those, you just do a great job and the clients hang around, and time sort of heals most things.
Okay. Another question from the audience. What are you doing on price? Do you think you're priced too lowly in core accounting services? And do you increase churn when you raise prices?
No is the answer. We want to price competitively because it is difficult. You can see our margins nearly twice that of the industry. So we know from a margin perspective, we're priced appropriately, and that makes it very difficult for competitors to compete. So we like that, but we are systematically raising prices, and that is growing our organic revenue growth. We're certainly not experiencing that we can't substantially raise our prices and not lose clients, which is great. So most of that 7.5% organic growth would have been price rise in the last 6 months. Okay. We know that because a lot of people have left the industry and a lot of older people are leaving the industry, there's going to be a lot less accountants. So we're quite confident that we're going to be able to raise prices quite considerably over time.
And then if we can talk about one of the smaller sections of the business currently, the investment office and the insurance broking operations, maybe what are the plans there and for expansion, and I guess how has it gone since you've launched it? I think maybe, is it back 2 years ago now the investment office started?
So the investment office, I think we did 4 years ago. First fund was 5.6 million. Second fund has now got about 30 million in it. We're confident that if that keeps doubling every 3 years, that'll turn out to be quite a good business. Insurance, we're doing quite a lot of life insurance. Our general insurance is a long-term, very slow growth style of business, and we're not confident that we've got that business doing all it can. But frankly, we see the complementary businesses as interesting but relevant long-term, irrelevant short-term.
And then on the overseas expansion, in order to expand overseas given the lack of scale? Do you anticipate to operate with the same 9% services fees for UK, US firms, or will this differ from the norm?
No, we'll keep our services fees the same. I think it's worth mentioning that I grew the group from scratch with the same structure, and we had no scale at all. Started with 200,000 in revenues. So, my perspective is that going into the US and UK, we've got absolutely gigantic scale compared to what I started with. So, I guess it's just your perspective. My perspective is, there is no firm I'm aware of anywhere in the world that's got the structure that we have, and that is a growing source of competitive advantage in driving a flywheel of centralized services back to our offices. It just makes them better and better. So our run rate revenues over 93 million. With the deals that we expect to do this year, it'll be well in excess of 100. And at 9%, that's $9 million a year being invested under these firms. So if you take a like-for-like firm, a $5 million firm, there's two of them on the same street. We partner with one, they've got $9 million a year being invested under them. And the $5 million firm next door doesn't have 9 cents invested under them, because most partnerships, when they make $1, there's 5 partners, 5 million, they make $1 million profit. They take $1,100,000 home. They overdraw. They certainly don't reinvest 9% into the business. So that structural difference is proving to be a huge source of competitive advantage over time, allowing us to invest in our team, our digital, and other interesting things that we think will very much accelerate the gap between our firms and other firms in local markets. Probably the worst thing that can happen to an accounting firm in Australia that's doing about under 10 million bucks is that we partner with one of their friends on the same street, because our firms will be just dramatically better resourced and therefore much more competitive over time. That's working very well. Now, overseas markets, I started with no money in services fees. We've started with a bit more than we did in Australia, so we'll do okay.
Still a few more questions coming in on the international expansion side, so let's keep going with those. Will the regions be run decentralized with their own management? But I think from what you've said in your last answer, that it's a lot of it is still going to filter back to head office in terms of the shared services, at least anyway. So yeah, maybe just how you envision, let's say you get to those 15 or 20 practices in and around LA, how is that going to be run from your perspective?
Yeah, so there'll be a services team in each market, funded by the 9% of that market, where we're building tools, particularly digital tools and software stacks, to run over all of those markets. Obviously, there'll be a scale benefit. The major software stack that we've focused on building has only one part that changes in each of those markets, which is the tax lodgement part, but everything else will be consistent, in particular the proprietary software platform that we've been building. So we think that's okay. We've never used the term head office, and we never will. We have a services team that works under our businesses. They don't work for a head office, and there'll be that services team servicing those firms in each of their markets, paid for largely by each market. Great news is we've got thousands of pages of unique IP and systems and processes that are completely transportable across those markets, because those markets are very much more similar than different. They have exactly the same challenges and opportunities as Australia. The opportunity is just larger because the markets are just much, much, much larger. But the actual issues you're trying to solve are exactly the same issues. So it's particularly exciting. And the asymmetric return opportunity is huge. If we can buy a small firm, prove out our playbook, and start to just gently and quietly grow. We've built what I think will be in the top 15 largest firms in Australia within 12 months. And we've done that in 18 years. The market in California, for example, US, is 15 times the size of Australia. 12,500 target firms in California. There's 12,500 target firms in Australia. So it's for very little capital investment, we think there's a very much asymmetric opportunity for return for our shareholders on the intellectual property systems and processes and business systems that we've built.
And then, yeah, just a question from me. In terms of picking Los Angeles over another major region, whether that be Chicago or Atlanta or Boston, what was the overarching I guess attraction of LA versus San Francisco or San Diego? Was it just time difference, West Coast Australia West Coast US versus East Coast Australia, as opposed to looking at one of the bigger cities on the East Coast or bigger states on the East Coast like Florida, for example?
Yeah, very interesting question mark. There's a number of factors. First one is that if you want to be Australia's global accounting firm for private business owners, you need to be concerned with where Australian private business owners are playing. They are playing the largest expat communities of Australia are London and Los Angeles. Los Angeles is in the middle of London and Sydney, and sort of culture of LA is very much more open than the culture of the East Coast of America, and obviously much better located geographically. So that's the first thing. So Australian expats. Secondly, the geographical location. Thirdly, the size of the opportunity to grow. LA and California generally is the fourth largest economy in the world, with a very, very dynamic business environment that is very small and medium-sized business focused. So we have a US-based director, Lawrence Cunningham, who some of your listeners will be familiar with, and Lawrence is Deputy Chairman of Constellation Software, understands our programmatic acquisition mindset, and because of the thousands of firms in LA, we think that it's not overly ridiculous to suggest that we may be able to find some firms here that want to partner with us and have us work with them to improve their business. So similarly, our largest shareholders in London, he was very encouraging, both of them very encouraging of us looking at London, and we had a number of firms contact us out of Utah, out of London, out of Paris, out of the Nordic countries, to see whether we would be interested in partnering with them. So Australian expat, large dynamic opportunity. London's a global centre. LA's a global centre. We don't want to win the UK. We want to win London. We don't want to win the US. We want to win LA, so that we have a focused market entry opportunity that we think is manageable. But the asymmetric opportunity is huge, because if we get it right and our playbook, is effective, then you're talking in LA terms 15 times the size of Australia. So it's quite possible that without taking any substantial risk, there might be significant opportunity for the group and our shareholders and all of our people. I guess the last thing I've mentioned, and really the most important, is that over the next 25 years, the real battle in our industry is a battle for talent, as it is in probably any industry. And we think that by creating a dynamic global opportunity for our talent, we'll attract better people, and they'll be able to move around and work within our organisation in a way that they can't in any other. Because of our ability to work together, most global firms are sort of basically a hodgepodge of individual fiefdoms, which for talent means that they can't really move easily between offices. We aim to do the opposite of that.
And then a final question. Obviously, it's going to take a while to get up and running in each of these markets. What kind of investment from the main group is going to be required until these guys, get scale and get revenue coming in the door and, partners on board?
Well, it's a good question. I founded the business with my wife, Rebecca. We borrowed $160,000 and I had $200,000 worth of revenues. And I guess you can look at what we did with that. We feel that we're entering these markets with more going for us than we did before, than we certainly had in North Sydney when we started in 2006. And so I expect that we will invest less than $1 million in each of those markets over a 3 to 5 year period. And I expect that we can grow considerable businesses that are profitable and by size in those markets, and probably more effectively than we did in the first instance in Sydney, because we just we just didn't know then what we know now, and we didn't have the track record, the financing connections and understanding that we do now. So I'm not putting to the market any great rah-rah or excitement about what the opportunity is, but we think that there is a group in Germany called ETL. They own 850 firms in Germany, 200 outside Germany. Private group, 1.3 billion euro in revenue. They've been running 50 years, running a similar model to ours. So we do understand the size of the prize in terms of what's actually possible if you can stay focused for a very long time and do an excellent job of your core business, staying in that circle of competence.
Right, we're just up on time, so I think we'll leave it there. And thanks very much for coming back in and giving us an update. And for anybody who's wondering about that book that Brett was talking about, Ryan Holiday is the name of the author, and I've read it myself. It's an excellent read if you're into Stoicism, and Ryan definitely puts out a lot of content. He's worth checking out if that's something you're into. And Brett, hopefully we'll be able to get an update from you later on in 2023.
Mark, thanks so much for having us. I remember the first Coffee Microcaps event I did, and it introduced us to a number of quality shareholders who've been with us a long time now. And I really appreciate your interest in the group, and we'll get back to work and keep making things happen quietly.
Nicely. Okay. Thanks, and thanks, Kenneth, for joining us as well. And I do believe we have Jay Albany from Wide Open Agriculture standing by over in early doors in WA. Jay, if you want to start sharing your screen, I'll let you know when you can see when I can see the slides coming through. I can see the cover slide of your presentation now, Jay.
Okay, great.
And your audio sounds good as well.
Okay, hey Mark, thanks for having me. It is not letting me show video. Is that on purpose?
No, it should do. Let me just double check if I need to enable anything specific on my side. I don't believe so. Is this a video embedded in your presentation, Jay, or?
No, it just says so people can see my face.
Okay. No,
So sometimes it says disable
you can just go ahead with the slides. We won't really worry about the video. It's fine.
Okay, great. Mark, thanks for having me this morning. Hello, everyone. My name is Jay Albany. I am CEO of Wide Open Agriculture, ASX WOA. We are Australia's leading regenerative agriculture company. Before I get going into the details of the presentation, I wanted to just say to everyone, I am incoming CEO. I'm 2 months down, and I know you may be familiar with this story. We've been fortunate enough to present here before. I think it's worth another look. We have a dynamic team chasing a powerful opportunity, some of the largest markets in food, and we are kicking goals. So I'm out here telling you we are absolutely executing on our plan, and we are excited about the year ahead. So I'm going to take you through the sort of areas of the presentation today. We're gonna go over a few recent highlights. We had some big news yesterday. the sort of flagship product of the company is Bunteen Protein, which is a novel plant-based protein. We have a disruptive regenerative food brand and Dirty Clean Food that's doing well, and I'll briefly update you on that, and then share the outlook for the company. First of all, just quickly on Bunteen Protein. So this is our flagship product. This is a plant-based protein ingredient. We are positioning Bunteen Protein to compete for the next generation of vegan products in stores, things like Beyond Burger type products that you see in the grocery store and in restaurants. Products targeted towards vegetarians, vegans, and how they get the protein in those products that makes for a healthy diet. We're very excited about this. I'm going to give you more updates later in the presentation, but good news is, this product is developing on our commercial plans ahead of schedule for my own expectations, and we're excited about where it's headed. Yesterday, we announced a new financing agreement with National Australia Bank. Very excited about this. One of the things I wanted to make sure we did right out of the gate was shore up our balance sheet to follow through on some of these exciting projects. So Wide Open Agriculture's Dirty Clean Food brand is a regenerative food brand. We sell an oat milk in 5 countries and a few more coming online this year. It is produced with a partner and co-packer. With this financing, we'll provide cash available to accelerate domestic production, and probably more importantly, to integrate our oat milk with our plant-based protein, which is going to produce dairy equivalent protein level oat milk. So this would be a market leading differentiation in the oat milk category, and blended milk that can really flow through our distribution. I do want to clarify something on this debt. It is exciting. One, because we've partnered with one of the top banks in Australia. They're backing us. We have multiple projects in our company we're trying to advance, and having this relationship at the beginning, we think is evidence that we can pursue these projects with a stacked financing strategy. So very excited to be working with NAB. The other thing I just want to point out here is that, in the last couple of years, we've articulated we want to build an oat milk factory, and we want to build a commercial scale factory for plant-based protein. And over since I've been involved, I've been saying, we want to have one plant-based facility that can produce both products with synergy with Bunteen Protein and oat milk. So I think what's important to know about sort of bullet point 2, the project-based debt, almost anything that we would need to buy with capital equipment for an oat milk factory is equipment that is used to make Bunteen Protein. So it's really important to communicate that this does not mean we're going to go off and do a separate project. This means we're following through on a commitment we've made. We said to the market we're prioritizing Bunteen Protein because that is the biggest opportunity. And this is really, you should think of this as, the first step in moving towards commercial Bunteen Protein, and securing that we can launch the Bunteen Protein enhanced oat milk product. Just quickly, we're a growth company. These results are primarily related to the Dirty Clean Food regenerative food brand. It has really disrupted the food scene here in WA, and we're now expanding nationally and internationally. So look out for our products in the eastern states. The things that you'll see are our oat milk range and our cold brew range. So big news there. Look, good looking numbers here. We've grown every quarter and set records 14 quarters in a row. So proud of that. Last several quarters, we've been really focused on launching a big longer sales cycle product in Bunteen Protein, but it has step change potential in the payoff. So very excited that we continue to grow while the majority of the team and leadership is focused on accelerating Bunteen Protein. Super proud of this business. Good balance sheet, $11 million cash at the end of the quarter. Reasonable amount of shares outstanding. Enterprise value is probably around $20 million. So I do think this is a exciting time to get behind the company. There's optionality on Bunting protein with a reasonable value for the business we have. So I think it's pretty exciting. So now I'd like to talk to you about Bunting protein. This is, as I mentioned, this is our flagship product. This is sort of what the efforts of the company, top priority in the company, what we're really focused on. So a lot of you might be familiar with this product. WOA has highly concentrated exposure to plant-based proteins and plant-based food market. We see the biggest opportunity as coming from Bunting protein, which is a protein concentrate ingredient that can be sold in a variety of markets as adding protein to vegetarian products. This is driven by a global shift in how consumers are thinking about food. It is not a fad. It is a shift it is a fundamental shift in how people seek their protein. There is a global protein shortage, and this is a fast-growing market. It is not a fad. And we're positioning ourselves to really participate in this next generation, which is starting to happen. So why is Bunting protein a game changer? Just quickly, there's a lot of differentiated things here in the list, but I think what I would tell you to focus on is it's a nice combination of performance, nutrition, environmental benefits, and a special access to products. About 3/4 of the world's lupin is farmed here in Australia, and we have access to the majority of that in WA. So it's a really powerful competitive story. When I look at sort of where we are in this product line, I'll just say that we launched a pilot plant in June. And we opened that pilot plant. We've announced an agreement with a major global company called One Ltd in Australia. We are producing products that meets their spec, but we're really focused on going from a pilot scale plant to commercial scale production as quickly as possible. We have had enough interest, indications of interest around different geographies for different concepts that we are aggressively moving towards having access to a commercial plant. Now, just to break it down, you can see these are very large markets. Listen, if we hit our goals, this is a gigantic opportunity for us, even if we get anywhere close to what our vision is for this product. That said, our initial areas of success, where we're doing well in prospecting and business development, is really the alternatives to dairy space. So cheeses, your yogurts. We're also doing really well in milks. Obviously, we're making our own milk. It works so well. We're also doing really well in other areas where texture plays a key role. And so stability, texture, how the powder ingredient blends with something with a complex mouthfeel. So noodles, a very big market. Obviously, One Ltd is one of the top 3 noodle manufacturers in the world at the corporate level. So it is, our aim to have a real shot at getting into that part of that business. But there are many areas where we can really compete here. So we're very, very confident. We've advanced concepts for noodles, cheeses, milks to a point where we're competing for business right now. It's just not a research project anymore. So quickly, how are we doing? So we've spent the last really 12 months focusing on, maybe slightly lower than that, 12 to 18 months focusing on taking something from really lab scale to tens of grams to something that can produce 30 to 50 tons per annum. Pricing for plant proteins and in the premium scale, which is where Bunting protein sits, is something that we think is north of $10 a kilo Australian. So it seems to range from 8 to 12 for competitors, but we think we have We think we have additional performance attributes for the product that's worth us being in the higher end of that range. So a premium to pea protein, a significant premium to soy protein, probably similar to faba. Very exciting. The pilot plant is producing. We're able to make significant developments in our technology and how it's applied. We're installing a very large spray dryer during this quarter, which can take us from small production, which is maybe 20 to 50 kilograms a week, to 30 to 30 tons per year, 30 to 50 tons per year after that installation. So that is a key piece of equipment that will increase the throughput. That has arrived in Western Australia, so we'll be installing that soon. And then, yes, aggressive sampling. Now that the pilot plant is up and running, we are able to engage with prospects in a way that we couldn't before. We're able to go to them with, instead of providing them with just a powder, we're able to go to them with concepts so they can see how it tastes, and we can control the selling experience in a drink, in a cheese, in a noodle, in a yogurt, in a dip, and then. Obviously, we're also able to launch commercial products in Dirty Clean Food, which is our own food brand, where we can finish off that recipe to create a little bit of excitement from competitors and offering to work with them with a great product. So it's really coming along well. I would have to say that when this project first started, I did not think we'd be this far along here, but we are really at the point of how do we make commercial scale volumes quickly and to meet demand. So it's very exciting. So what we've said is that we'll announce additional updates on how the selling process is going this fiscal year, and that's not too far off. June 30 is our end of fiscal year. But we've been talking to some of the largest companies, some of the largest food and ingredient and commodity trading companies in the world. So we're very excited about what's going on here. And in general, this product, I think we're really kicking goals here. So I'm very excited to be able to give updates in the next quarter, 4 months. Just quickly back on this slide, I do want to say sort of large news during the last quarter was we are in final stages of negotiations with a partner to manufacture a manufacturing partner with us in country who would allow us to come to market less than half the time, significantly lower CapEx. Basically, we will bring to the partnership our special IP and the equipment needed for that, as well as the know-how for extracting plants, extracting the fiber protein and separating it from the fiber, and what to do with milling and disposal of co-product or selling co-products. And they will bring significant infrastructure, significant drying capacity, significant experience in global relationships from a more mature industry that is well positioned to partner with us. So this is going well. When we're able to say something to the market that quantifies the improvement, we will. That will be soon. It's an exciting time. I think we've really figured some things out here in this product line. So I'm very excited to have the opportunity when I can to update the market on this. I know the majority of what investors follow is Spontine protein, because the potential upside, if we are successful there, is so significant. But I do just want to quickly update you on the core business, which is the Dirty Clean Food regenerative food brand. Very healthy growth in the year. We've really established a strong presence in Western Australia. I hope for those of you on the eastern states that you'll come out and take a look at our facility sometime, or shop around, and so you can see and taste the products. But more than that, I hope you start to see our products popping up on your shelves, because we are aggressively moving into the eastern states in the beverages spot. You can find our products in Woolworths, and you'll be able to find our products in a lot more places soon. Also for sale internationally, Australia has an infrastructure and economy set up really well for clean grain food distributed into Asia. So, we are working aggressively on that. The reception for our regenerative food message is actually going really well in Asia. So I expect to see additional countries soon. In terms of how the brand is doing, look, a little less than $11 million trailing sales. We work with top players in every market that we're in. I don't think, I'm proud of the collection of places where our food is sold, and I see this business reaching scale that I think will be pretty exciting. Do want to allow for questions, but just to quickly recap on our outlook. This is our outlook for second half of the year, ends June 30th. Multiple new offtakes for Bunting protein announced by June 30th. Clarity and an agreement on commercial production of Bunting protein also announced by that time. The existing business will grow while we focus on, even though we'll be focusing on improving margins and operating efficiency, it will still grow. And multiple Bunting protein products at Dirty Clean Food, that's really as evidence and assisting our BD process for Bunting protein, but they're also amazing products. And then obviously we'll provide an update on the oat milk of Bunting protein, which will be manufactured here when we have completed the Bunting protein commercial production announcement. Thank you very much.
Thanks, Jay. I just wanted to touch on the Bunting equipment story. You said you one major piece has arrived in WA. Is there any other long lead time equipment you need to get the plant install going, and post that kind of tweaking, final commissioning and stuff, or is that piece of equipment kind of the last piece you need to really get the plant install going?
Yes, good question. So that is, just to be clear, that is for our pilot scale plant. So that will take us from where we are now, which is 50 to 100 kilograms a week, to 30 to 50 tons per annum. Out of Kewdale, a customer at commercial scale is hundreds, low thousands of tons. So our main focus is, I just want to be clear, and I'll answer that question. Our main focus is how quickly can we get commercial scale production. So we need access to much larger dryers, but we do need to have the pilot plant producing enough volume to sort of have a bridging strategy as we go there. But yes, that is basically the last piece of equipment for the pilot plant to reach its capacity. It is a large dryer. It's a complex installation, but we'll be starting that shortly. It's already paid for, so you would have seen that in our results that we've already posted. So excited for that. That's going to really allow us to learn a lot with how to work with large format dryers. We do have a dryer already that's working, so we are producing consistently to spec, but this will be a test and scale up to a larger scale before we go to the thousands of tons scale.
And then just in terms of, there's so, you reference, food fads there, you've got vegan and vegetarian and various diets, keto diets, but in terms of market awareness that, maybe you need to drive in terms of educating people on regenerative agriculture, where do you find, you talked about the reception the products are getting up in Asia, which has been a pleasing surprise. Do you find that there's kind of a groundswell of knowledge that's building up, and people are starting to not only become aware but starting to seek out products that come from a regenerative agriculture producer?
Thanks, Mark. That's a good question. Yeah, so when I joined WOA, when I joined Wide Open, kind of just to launch Dirty Clean Food, regenerative was very much a niche concept. Right now, over the last couple of years, it's really gained traction globally. Really during sometime in the end of year one of COVID, it really picked up in terms of global awareness and has begun to be embraced. So it's actually been our status as a regenerative leader not only makes delicious, healthy, environmentally friendly food, but it is actually sort of an anchor for how we can work with some of these large multinational companies. Is they're all interested and understand that regenerative is likely to be the next super cycle in food, similar to organic, and we are sort of an existing thought leader and with a brand in a non-threatening geography that they can partner up with and try to work with us to make that work in their market too. So I would definitely say that yeah, it is definitely, the environment has definitely changed for me having to explain what regenerative is 3 years ago when I'm prospecting to people coming inbound to us.
Okay, I even heard one or two guests on the Joe Rogan show lately, which kind of piqued my interest a bit. That you can have your own view on Joe Rogan, but one thing you definitely can't say is he hasn't got a large audience, and the fact that he's getting guests in on this topic, suggests that it's something that a large, wider group of people are definitely interested in.
Yeah, I mean, I'd encourage you to think back to that slide with the top retailers in every market and the scale of partners. I mean, how many companies do you know who are in Woolworths, within a year of launching a product, and domestically, but then internationally, we're in top retailers in every market. There's interest. With our Bunting protein, it's a huge differentiator. Basically, all of the competitive products that you see in the grocery store now, and I encourage you to go look. The majority of them are soy protein, which is hugely commoditized and requires the food manufacturer to put in many numbered and strange emulsifying looking ingredients that sort of undercut the whole premise of that product category. So Bunting protein has the gelation and solubility attributes that. And the reason we're so excited about this is that, and we can charge a premium for it, is because that we can help them have a cleaner ingredient list, and the companies look for that. And then on top of that, Australia is a leading provider of lupins. We are building a regenerative lupin network to support this, and so we can have a sort of environmental story layered in to a customer who really cares about this. So they can. I think it is the right time for this idea, and I think we're the right group of people to capitalize on it.
And then just on the sales chart that you had up there, is that step up purely getting the Dirty Clean food brand onto the shelves in more Woolworths and Harris Farms over on the eastern states, or is it a combination of that plus people actively seeking you out through your online store and kind of not waiting for it to pop up at their local Woolworths where they're actually buying online as well?
Yeah, that's a good question. So excuse me. Yeah, there's a pretty significant step up about 3 quarters ago, where that was, yes, that is I mean that's obviously that quarter, and then a little bit of the quarter before, you can see us getting some large distribution deals flowing through the results. And it's not only Woolworths, it's into Asia as well, and we did have a strong quarter in our digital business. It's really pretty broad based. I would say that through that period, the majority of the growth is from the oat milk and the digital business. So the oat milk expanding into new regions, and then us. When you have an oat milk order or any order of a new product that goes into grocery at scale in a new country, there are initial orders to fill the channel. So I'm although it looks like the business is sort of growth has slowed a little bit, you have to understand that we had a massive leap, and then as that has digested, we've continued to have good sell through. So it's a big win for us. And the other thing is, honestly, we've heard the feedback from. Oh, it's not even the feedback. We have identified and are aware that Bunting protein is, a step change potential product, and it is ready for commercialization. So we've had the majority of our efforts for the last couple of quarters focused on that. Those are longer sales cycle opportunities, but they're, multiples larger than the existing business in terms of potential. So it's the right thing to do for the company, and I think it'll make that chart look a lot better if we're successful.
Okay, let me just check if we got any further ones from the audience. No, I don't think we do. And we're just bang on time there, Jay. So I think we'll leave it there for this morning. Thanks very much for joining us early from WA. I really appreciate you getting up early and coming on to give us an update on all things WOA. And we'll keep an eye out for further announcements. Sounds like there's going to be quite a few interesting things happening over the second half and the course of 2023.
Thanks, Mark. Yes, stay tuned. We feel like we're kicking gold, and we're excited to share the next several quarters. Thanks.